Happy Saturday, everybody. Guys, apartments, offices, retail, you name it. It's a slow moving train wreck. What do I mean by that? We are going to look at loans that are maturing next year. We're going to look at two properties. They've got loans coming due next year. Both of these properties are writing six-figure checks to pay the bills. I'm talking about that's how much they're losing. Massive cash flow losses on both of these properties. Do you think they're going to be able to refinance? Well, I don't think so, but I'll show you the data. You guys decide. It's all public information. My name's Ethan Flynn. I'm a CPA. I'm a licensed real estate agent. I love real estate and data, and I'm just trying to learn and share what I learned with you guys. And without further ado, let's get into the data. Okay, so first things first, a prize-winning real estate economist says the office market won't improve for years. This is a train wreck in slow motion. Now, we just talked about this in my Wednesday video of how, most people are seeing this. Loans are coming due in the next 12 months. And only after a lot of this stuff starts maturing are we going to see things come to fruition and actually get flushed out and repriced. Now, you hear a lot of people say, oh, but there's dry powder out there. Guys, dry powder will still only buy market rate stuff. And if the market's getting repriced because the net operating income isn't there, or, it doesn't matter how much dry powder you have, nobody's going to buy a speculative investment in an environment where you can get a 5-6% return just by buying, U.S. treasuries. Let's set the stage for office here. Charlotte, Nashville, among markets with the biggest jump in office vacancies. You can see office vacancies are just absolutely scorching. They're skyrocketing from where they were just a few short years ago. And we all know this from the pandemic, but what does it mean? Well, here in Nashville, absorption is down 200,000 square feet. Now, we're in the latter part of 2023, and just 12 short months ago, people are still renewing their leases with smaller footprints. Even as people move to Nashville, there's less and less square footage being rented, and we have 3.7 million square feet under construction. You and I both know with a 12% vacancy rate that the math just doesn't work here. It's not looking good. So let's take a look at a property in the office space. Now, this was in March of 2022. So this is not even, like 18 months ago. Florida developer enters Nashville real estate scene by acquiring downtown LNC Tower. Now, LNC Tower is a historic building. Believe it or not, it's actually in the background of The Matrix. At the very opening scene where Trinity's running on the roof, go watch it. It's actually in there. One of the tallest commercial buildings. It was built in the mid-60s. They were very excited to buy this property for what was appraised at $53 million, and they were going to build it out. So they got a loan for $37 million with an additional $10 million to build out office suites and office spaces, get it ready, improve it. And what is happening here? Well, this is information on their actual loan. And the first thing I want to show you is that the LNC complex has been added to the watch list because the debt service coverage ratio is 0.69. Now, they're not getting enough rent to cover their debt. That's essentially anything under 1 means that they are paying out every single month, and to the tune of a lot, because 0.69 is terrible. It's terrible. Now, why? Because the office is only 59% occupied. So they're still making their payments, but the office is only 59% occupied. You can see this loan is maturing in April of 2024. Now you say, okay, well, how much is this $47.5 million loan? It's 6.9%, guys. This was a variable rate loan at 6.9% on $47.5 million. What does that put us? It's $3.3 million a year. Now, come over here. We can see their NOI fully leased and stabilized would be 4.7, but they're actually only at 2.7 when they bought it. Now, they bought it with a higher occupancy that they have now. Let's see if it shows it right here. Yeah, when they bought it physical occupancy 64%. So it's about where it was now. It has not improved at all. So we can assume probably that they're getting about the same net operating income. Why is that a problem? Because they're paying $600,000 to cover their debt, and now it's maturing. Do you think they're going to be able to get a 47.5? They're probably going to try to extend, and they're probably going to try to work with the lender because the lender knows that this is in trouble. Let's take a look. Let's go downtown again at Church Street. Now, Church Street right here, this is just outside of downtown. Here's Broadway, super popular Broadway. Church Street, we've got Margot that's having a massive problem. We've got Olympus that has 20 units, but there's another one right here that doesn't show on Zillow because it's not advertised on Zillow. But guys, this one has 46 units available. It's 1818 Church Street. Look at this, 7 units, 3 units, 4 units, 31 units available. One unit available, one unit available. Guys, this thing is, I don't want to say it's empty. It's 46 units are available out of 142. It's 68% leased up. Now, interestingly enough, we've got the debt information on this one. This one was borrowed, got a $26,300,000. Okay, this is an ARM with an interest rate cap of 5.65. So you can guess what they're paying, 5.65. All right, now when we look at this, that interest rate, they're going to pay 5.65%. They're going to be paying about $1.5 million in interest on this loan. Now, these are interest-only loans, guys. Wouldn't you like an interest-only loan? And they said that the net operating income when they got it was $1.2 million. Now, the full potential stabilized NOI was $2 million. So everybody's like, oh yeah, it's 2021. Of course, we can loan that to you. No big deal. June of 2021, everything was free. Now we're in 2023. We know that's not the case. And so what's the problem here? Well, the problem is that when they bought this, believe it or not, the occupancy was 87%. Where is it now? It's 68%, guys. 68%. So do you think they're getting 1.2 million of net operating income? I'll tell you, I did my math. If we look at CoStar again, we take 142 minus 46, that's 96 units that are occupied. We're effective rent is $1,700 a month. You're getting essentially $1.95 million a year in gross rents. Now you take that gross rent, $422,000 in taxes. I fixed my insurance estimate, by the way, guys. I found this article in CoStar that helped me with interest. So I'm only factoring in about $350 a unit for insurance. So $50K for insurance, $136,000 to manage this. And so excluding maintenance, you're still only looking at $1.3 million. So is it getting 1.2? Let's assume it is. It's getting 1.2. Guys, they are paying an interest-only loan on this of 1.5. This is bleeding cash of $300,000. And it matures in July of 2024. So the question you have to ask yourself is this actually going to mature? Are they going to be able to extend this? Who's actually negotiating the terms of this loan? And who's actually supposed to be getting the interest? I mean, is it me and you? I don't know. Is it in our 401k? I don't know. But what I do know is clearly they're upside down on this thing. And if you value it at a 5 cap, everybody's like, oh, the market's gone to a 5 cap. Okay, we'll take 1.2 million, which it has been for years now, 1.2 million. So take 1.2 million net operating income at a 5 cap, and what do you get? $24 million. So the value of this property is somewhere around $24 million at a 5 cap, which I think is insane. I don't think it's a 5 cap. I would not buy this for a 5 cap. I don't think that's worth a 5 cap. Something that hasn't been able to stabilize in years does not deserve a 5 cap. But whatever. The bottom line is $24 million is less than the balance of the loan due in July. They've got massive problems. That's what I want you to see here, guys. These are coming due. They're going to be repriced. Guess what dry powder is going to do for this thing? Dry powder is not going to do anything for this. It's still going to get repriced. Why would anybody buy this below market value when, after 3 years, it couldn't be stabilized and you literally have apartments all the way around it with dozens and dozens of units available? It's going to be trouble, guys. Rents in free fall. You've got massive vacancy. You've got apartment that's not stabilized, that's got to refinance. It's going to get repriced. So it's going to be bad out there, guys. So don't think dry powder is just this magic wand answer for this stuff. Still going to get repriced. Now, I am going to do a market update on housing, but I'm still trying to get a feel for what is happening in the market. I will pass it along. I may post something in my Substack if I get it sooner, or it may be next week. But with that, I hope you guys have a great rest of the day, and I'll see you next week.